Rate decision uncertainty stifles sector allocation. The effective rate has plateaued around 3.63% with minor variance across multiple Fed series. This narrow band signals market pricing of a whole decision, but the lack of forward guidance from the Fed leaves investors without a catalyst for decisive action. The risk is missed entry points in cyclical stocks or gold if the decision goes the other way. The current 3.63% federal fund rate as of June 2026 creates a wait-and-see environment. Asset managers and individual investors lack clarity on the Fed's next move, making it difficult to commit capital to rate-sensitive sectors like real estate, financials, or gold. This indecision dampens trading volumes and postpones strategic portfolio shifts. Gold price sensitivity hinges on Fed tone. A historical SEC filing from Spider Gold Trust serves as a documented precedent of market expectation tied to the June Fed meeting. Today, the same dynamic applies. Gold investors are positioned for a dovish outcome. A rate hold or cut would likely be bullish, but a surprise hike would devastate leveraged gold positions and mining equities. And no kidding, look at this here. Gold is literally trading at 4,154. It actually went down. And silver is sitting at 64, close to $65. It went to about 63.94. Gold heads for third weekly loss on firm dollar, hawkish Fed signals. Silver pressured by hawkish Fed signals. Gold and precious metals following a dovish decision. If the Fed holds or cuts, gold is set to rally based on historical patterns and reduce opportunity cost of holding non-yielding assets. Miners like Seabridge Gold offer leverage exposure, regional bank net interest margin expansion. The Fed rate plateau provides a stable lending environment. Regional banks, example RF, FITB, can benefit without the volatility of a rapid hiking or cutting cycle. The opportunity is to identify banks with strong commercial lending franchises that can expand margins without taking excessive credit risk. Trends. The tight clustering of rates across 5 different series indicates exceptionally low market uncertainty about the immediate rate decision. This rare calm may be the calm before a storm if the Fed's statement or dot plot surprises. For content creators and product builders, this is the moment to prepare scenario analysis for both a hawkish and dovish outcome. This is definitely talking about me, yours truly. What's the best actionable takeaway for retail investors? Based solely on the scan data, the best actionable takeaway for retail investors is to position for a potential gold rally following the June FOMC meeting. The scan explicitly ties gold's best days to a dovish or hold decision from the Fed, and the current 3.63 rate reduces the opportunity cost of holding gold. For leverage exposure, the scan points to miners like Seabridge Gold. Alternatively, the scan identifies regional banks as a second opportunity. The stable rate environment allows them to optimize net interest margins. The decision hinges on the Fed's tone, so investors should monitor the meeting outcome closely before committing capital. And now let's talk about the inflation real quick. Commodity exporters and precious metals like silver may benefit from persistent inflation and geopolitical tensions, offering hedging opportunities as rate hikes peak. The Iran war's inflation effects may persist even after conflict ends, keeping prices elevated and forcing further rate hikes that could tip economies into recession. Maintain a defensive portfolio with exposure to commodities and short-duration bonds. Monitor central bank signals for pivot timing, and consider hedging against yen volatility ahead of Japanese subsidy unwinding. This is extremely important. A lot of people are not paying attention to this. The Japan carry trade. Europe's mid-sized inflation shock needs measured response. The ECB is navigating a delicate balance, containing inflation without choking growth. The Iran war and energy costs are key drivers, making the outlook uncertain. Lane's comments suggest gradual tightening rather than aggressive moves. Russia to cut key rate as Iran war while dividend eases inflation. Russia actually plans to cut rate while the Fed chair is giving us a dovish look. Fed holds rate signals future increases. Alright, I was wrong. Probably hawkish here. The Federal Reserve kept interest rates unchanged but leaned toward future increases to combat inflation. The decision balances persistent price pressures with geopolitical uncertainties. Japan core inflation holds steady despite energy concerns. Japan's inflation remains below target, but energy subsidies are artificially suppressing CPI. When subsidies end, inflation could rise, pressuring the Bank of Japan to adjust policy. This creates uncertainty for Japan's monetary outlook. The country that holds the largest US treasuries, something to pay attention to. Inflation pain could linger even after Iran war ends. The Iran war has driven energy and commodity prices with effects now embedded into broader price levels. Even if tensions ease, Reversing these price shifts could take months, delaying relief for consumers and businesses. Warsh rattles markets with inflation vow. Kevin Warsh, new Federal Reserve Chair, signals aggressive inflation fight, likely with future rate hikes spooking markets. The Fed held rates steady but leans toward increases. Bank of England holds rate, lower inflation forecast. The biggest risk is that inflation pain will persist even after the Iran war ends due to baked-in costs from energy and supply chain disruptions. This risk is underscored by the Federal Reserve signal of future rate increases to combat inflation, a move that could raise borrowing costs and impact growth-sensitive sectors. The lingering inflation, combined with tighter monetary policy from major central banks like the Fed and ECB, European Central Bank, creates a prolonged period of economic uncertainty that could delay relief for consumers and businesses. In this environment of extreme uncertainty, you have to be very cautious, especially if you're playing in the stock market. And then we have a lot of IPOs coming. I'm just gonna watch from the sideline for now. Ladies and gents, I hope you found this useful. Subscribe, and I'll see you in the next one. Bye for now.